the camera on to get good.
Yeah. Good afternoon, everybody. My name is Michael Sakosho. I'm the 2024 Rhode Island Commercial Appraisal Board president. And thank you for our first CEU course that we're doing. Hopefully many. And today it'll be obviously a 1031 tax exchange. Our guest today is Patty Flowers. Patty is vice president of IPX 1031 and should be obviously be our presenter. Some ground rules for this class, because we are a CEU class, is your cameras have to be on. There's a number of people there that don't have their cameras on, so please turn on your cameras. You'll also be asked if you want credit, some questions and polls during this event to satisfy Department of Business regulations rulings for us to obtain the CEU classes. Commercial board has been very busy. We have some upcoming events that people might want to participate in. The next one is an RPAC fundraiser, a meet and greet. It's going to be held on May 16th at Sports and Leisure. It's a sports bar, obviously, in Providence on North Main Street, and that event will run from 4 to 6. So hopefully we'll see some people there, some faces, and do a meet and greet, and hopefully raise good amount of money for our PAC. I want to welcome Patty and talk to her a little bit about what she's going to be doing today. So I give you the floor, Patty. It's all yours. Go to it.
Okay, very good. So just going to have, you can share my screen. Can you see the 1031 exchange on your screens?
Patty, we just see you.
I don't have it.
Sarah, do you need to share my screen?
You're a co-host, so you should be able to share your screen on the platform.
Try it again now, Patty.
You can see me, but not the PowerPoint.
Yeah, and you hit the share screen on your toolbar on the Zoom.
Green box, share content.
I don't have a toolbar.
Oh,
At the top, do you have settings where it looks like there could be a drop down for the events happening?
I just have a view, full screen, self.
Do you have a spot where it says mute, start video, participants? Do you have dual screens on your computer?
No.
people went out there.
I don't believe that I'm registered. I don't have any of the controls that I normally do. So I don't think that I'm in as a presenter.
Your status is changed to co-host on our side.
Right, well, let's see. Okay, hold on 1 second. Can you see it now?
There you go. Perfect.
There we go. All right.
That was
A
the
technical glitch is over. It's all yours, Patty. I can see it.
I needed to be the co-host. Perfect. So very good. So let's just start at the beginning. Everyone can see the blue and white and black screen, investment property exchange.
Yeah, we can see that, and you see your contacts.
Perfect. Very good. Thank you so much. So I'm Patty Flowers. I'm with IPX 1031 Exchange. I know some of you on the line today, but thank you all for coming. IPX is a qualified intermediary. We're the largest and one of the oldest in the country. Been doing 1031 exchanges. This is all we do all day, every day. I'm doing it for over 40 years. I'm based in Boston and I manage the New England area for IPX. And I've been doing this for over 20 years. So we've seen it all. I think we have answers to almost every question. And if we don't, we, hopefully know where to get them, or the client's tax advisors can help. But the goal today, we just have an hour. It's a continuing ed, so everyone has to be on the line and visible. If you're not visible, you have to be, or I'm not allowed to give the credits per the state of Rhode Island. And you'll have to stay on, and you'll see questions throughout the hour that you need to reply to in order to get the continuing education online. They're pretty strict about it, so I don't have any control. I just do what I'm told. So we're going to go ahead now. I think all of you are pretty aware of what a 1031 exchange is. Clients are selling investment property. They're buying new investment property. And by doing so, if they follow all the rules that are set up under the tax guidelines, they actually do not have to pay any of the capital gains tax at the state or federal level. It's not a tax-free exchange exactly in the year that you do it. It's considered a tax deferral, which means that the gain, depreciation taken, all of that basis is all recorded in the year of the sale, recognized, but not realized. So the IRS knows you had a gain, they know they had a sale, but instead they say, okay, you did an exchange, you don't have to pay the taxes. A lot of people will keep exchanging as they go through life. So it keeps being deferred as they go. We'll talk about some estate planning benefits as well for 1031, exactly what qualifies. And I have a few advanced topics for today. Reverse exchanges have been very popular, hot topic of conversation and phone calls. So we'll cover that. We have a lot of partnership and LLC issues. So if you have clients that are in multiple member entities, this would be a good topic for you as well. But we'll do some basics first, just because I feel like people call every day and they've gotten bad information either online or from their tax advisors or legal advisors. They've heard it from a friend and it's not right. So I just thought we would kind of run through a few things specifically. What you are deferring when you do a 1031 exchange, the federal capital gains tax is either 15 or 20%, depending on the taxpayers, who the taxpayer is. Any depreciation taken over the years, the normal wear and tear, that's taxed at 25%. When someone sells property, may it be real estate or stocks, or they might have had lottery winnings, if you make over a certain amount of money that year, you actually have to pay an additional 3.8 tax to the federal government. That's that Obamacare healthcare tax to fund the healthcare system. You all know about the state capital gains taxes. Every state is different. Rhode Island has a state capital gains tax. And so when people say, well, I don't even know what I would pay in taxes, I ask them to call their accountant. But I say, with all these 4 taxes in consideration, you're probably going to owe right around 30% in taxes when you total it up. So whatever the gain is on a property, I would safe bet would be you'd owe about 30% if you sold it outright. The 5th tax I have listed here is the non-resident withholding tax. So in Rhode Island, you know that if a non-resident is selling property, at the sale closing, the government expects that the settlement agent hold back some money to pay, just in case the taxpayer forgets, quote unquote, to come back and pay their state capital gains taxes. So if any of you have clients who are non-residents selling investment property in Rhode Island, they can actually get the withholding tax waived ahead of time before sale closing. So anytime I get a client in, it's kind of hard to tell these days with everyone with their cell phone number, it moves with them. But when we're talking, if they're selling property in a withholding state, I always ask them, are they a resident or not? And so I encourage them to get the form started as soon as possible. There's some Q&A to do with the state and some forms to fill out. So when you do a 1031 exchange, obviously nobody wants to pay the taxes. This is just a kind of a very simple, easy math example. If you sold a property for $1 million and you've had it forever, your basis is low at 100,000, you might owe about 200,000 or 225 in taxes in the year that you sell. If you set that same sale up as a 1031 exchange, and you followed all the rules in the middle and went on and bought other property for $1 million or greater, you actually could have 0 taxes due. So it's a really great option for clients. They know something's out there that exists. They're getting better at it. Their friends are telling them, oh, I did an exchange, you should too. So I think the more that you know as a commercial broker, the more that you know out there, the better off you'll be, because when they ask you about it, you don't have to know everything, but hopefully after this presentation today, you'll be able to have some nice conversations with them. And of course, I can help along the way. Nobody wants to pay the taxes, of course, but there's plenty of other reasons why someone might do a 1031 exchange. So just going around the circle here, starting at 11 o'clock, cash flow. Raw land is considered investment for a 1031. So if you have a client who has a piece of land, they thought they were going to build something on it, they bought it and aren't really getting very far with the city or town and decide, I don't want this anymore, they could actually sell land and do a 1031 exchange and buy an improved property that they're going to automatically start getting income from and increase their cash flow. Depreciation. I talked about you can, depreciation, recapture tax, it's involved when you sell a property. If you have clients who have owned the property for an extended period of time, they might be getting close to being fully depreciated and not able to get those write-offs every year. So they're talking to you, thinking about selling it because they really want those write-offs to help on their return. If a client sells in a 1031 exchange, we'll do the dollar values later, but normally if you sell for $1 million, your goal is to buy for $1 million. If you sold that property for $1 million and it was fully depreciated, even if you do an exchange, when you buy a new property for $1 million, because it's tax deferred, that depreciation you've taken follows you across to the next property. So that wouldn't help that client's cause. But if he sold for $1 million and bought for 1.2 million, now he's opened up a new window of 200,000 that they can start to take write-offs from. So if depreciation is their main reason to exchange, they do need to buy of greater value than they sold. Appreciation. I say slow market, hard market, who knows what's what anymore, but obviously inventory is low. It's difficult to find properties. Some values are still through the roof, depending on what type of property and its location. The values are high. So you can sell and buy anywhere. You can stay in the same town and, buy in Providence, sell in Warwick. You could go state to state. You can do an exchange anywhere in the United States. So it really could be something where they have a property, they've been leasing it out, or maybe it's a big apartment building and, they're getting okay rents, but they'd really have to do some major improvements to get better rents. But instead they might decide, I'm just going to sell it as is and buy the nicer, newer building down the street or across town or the next town over, where they're already getting better rents than I was getting, and I don't have to do any work to the property. So then you'd have automatic appreciation. Conversion. I know most of you don't do residential properties, but a lot of clients who do 1031 exchanges, whether they're selling commercial, apartment buildings, residential rental, a lot of them have their eye on the prize that they want to buy as replacement property, maybe a single family rental or a condo rental that they eventually want to make their primary residence in retirement or a vacation or second home down the road for their family. So even when you have clients selling commercial property, if they have money left over or they decide to buy 2 or 3 replacement properties, sometimes this is their plan. They want to buy something that they can use personally down the road. Of course, it's mostly on the residential side, but it is an option for anyone. Joint ownership. In a 1031 exchange, we talk about the entity that sells has to be the entity that buys in a 1031. And so the problem comes along if you have multiple member LLCs or partnerships where inside the entity, maybe they don't get along, they want to sell the property and go their separate ways. but they don't want to pay the taxes. So we'll talk about the vesting a little bit later and some options for partnerships and LLCs. Reduce management burdens. You can go into properties that are more hands-off management. Sometimes clients, are kind of sick of managing the properties. They can go into single net lease, triple net lease properties, tenant and commons on the national level, or the DST programs, Delaware Statutory Trust. Those are all options that we'll talk about. Estate planning. This might not matter as much if you have clients in LLCs or partnerships, but for anybody who is in any type of entity, if they have an estate plan in place, if they've been doing 1031 exchanges and they pass away, their heirs automatically get the stepped up basis. So that's a great thing. And a lot of clients that I have say, I want my money to go to my grandkids or their college education or what have you. I don't want to have to pay it to the government. So estate planning really falls into play with 1031. As we talk about different properties that qualify, medical buildings, residential rental apartments, mixed use, retail, land, I already mentioned, even timber rights or air rights or mineral rights, single net, triple net properties. Everything counts as long as it's real property and they've been using it for investment or business use. So that term like kind is a little bit misleading. People think that like kind means, oh, if I sell my industrial building, I have to buy another industrial building. And that's not true. You can actually sell an industrial building and buy retail or an apartment complex, whatever you want to buy. So the like kind term really means how you use it. You use it for investment or business use, not what the property looks like. So therefore, anything that's real estate is really like kind to anything else that's real estate. 1031 has been a great motive over the years, a great tool. It helps promote real estate. It helps promote income for cities and towns. When you sell property, the cities and states get their tax money. Brokers, you get your commissions. You have builders and construction workers coming in to upgrade properties. They have business. The legal community's involved. So it's really a good program for everybody. There's no downside. It never hurts the opposite party in a 1031 exchange. Other types of property that's considered real estate for 1031, leases with at least 30 years remaining, including the renewal options. So if someone's selling a 20-year lease and they have five-year renewals, that's up over 30 total, they can do a 1031 exchange. They can either go and buy another 30-year plus lease, or they can actually buy fee simple. So any leases with at least 30 years remaining are considered like kind to fee simple. Perpetual easements are okay for 1031, and the most common one I see are the cell phone towers. Most of those are perpetual easements, and they can be done as a 1031 exchange. Undivided interest or 100% interest, you can own any percentage of property. So you might have 2 or 3 people, 2 or 3 entities on title as tenants in common. If one wants to sell their third and do a 1031 exchange, they can go on and do that. They don't have to own 100% of it. And I already mentioned the timber rights, riparian rights, air rights, all of that. So those are all still considered real property for 1031. What you cannot do a 1031 exchange with, the most important you might see is partnership interests. So even though you might not be listing a property to sell, they might be talking to you about that. And one of their alternatives is for one of the partners to maybe sell their interest in the entity. Well, that's not a 1031 exchange. Even though the entity, the partnership might own real estate, if you're selling your interest in an entity, that does not qualify. Stocks and bonds and notes, your primary residence doesn't qualify. Stock and trade, securities, none of these qualify for 1031. The one thing I'll mention, even though, a lot of people who own commercial property or a lot of people you come in contact with, maybe even yourselves, own vacation and second homes. So I always bring this up no matter who the audience is. In 1031 exchange, vacation and second homes have very specific rules attached to them. in a regular 1031 exchange, there's no particular time of how long you have to own something. So most advisors feel at least 1 year is appropriate. You own something for at least a year, you've been leasing it out, collecting rents, etc. That qualifies as property for investment in a 1031. However, in 2008, the IRS said if you have a property that's considered a vacation or second home, and in that scenario, you may or may not rent it year round. But if you don't, you have to follow these regulations. So the taxpayer, the person who owns the property, must have owned it for 2 full calendar years before they're allowed to sell it as part of an exchange. So I just got finished saying 1 year is fine if you have a year-round lease or year-round rentals, but if it's short-term, VRBO, partial year, a lot of properties might be half-year rentals or just summer rentals. They have to have owned it for 24 months, 2 full years. Number 2, the taxpayer must rent the property at least 14 days per year in each of the last 2 12-month cycles. So that's pretty easy to do, right? You could rent something for 2 years. But number 3 is actually the kicker. The taxpayer owner's personal use cannot exceed 14 days per year or 10% of the total time rented. So if you own a property on the beach, on the ocean, wherever it may be, and you rent it only 2 weeks, 3 weeks, 4 weeks, just a few weeks a year, a few months a year, that means you as the owner can only use it personally, family use and enjoyment, for 14 days per year. That means it's going to sit vacant the rest of the times, right? So you have to really be careful. If clients call and they say they're selling a property, I always ask them, has this been a year-round rental? How many years have you been renting it? And if it's, if there's not a year-round rental, we definitely need to talk about these scenarios. Also, the same rules apply going forward with the new replacement property. So really the key is, was it held for personal use and enjoyment? Or was it held for investment business use? So when we do a 1031 exchange, I'm just going to kind of run through the scenario of how it works, and then we'll touch on the dollar value rules and timelines for a minute. So everything about your listing goes completely as normal. So you're talking to the client, you decide they're going to sell the property, you put together a listing, you put it on CoStar, you put on whatever you market it, however you market the property, you entertain offers and get a buyer. All that's done completely as normal. Your office can hold the deposit if that's normally what you would do, totally fine to hold the deposit. However, sometime in between when the seller decides to sell and that sale closing date, we as the qualified intermediary have to be involved. So what happens is that you would email us. I mean, certainly we could talk to the client anytime, go over the rules, what are their options, etc. And I have a nice email that I send out to everybody, and here's a summary, and this is what I need. But in fact, I really need the signed purchase and sale agreement to get started. So someone will email that to me. I read through it, ask questions, and then we're going to open an exchange account exactly the way the seller name is listed on the P&S. So if the seller name is not how they're on title, then it's going to have to be amended because we copy it word for word, letter for letter, typo for typo. We open the escrow account is the exchange account, and we open that. We prepare documents for the taxpayer, your seller, that you have to sign. We send a copy of the exchange instructions, and we always CC you, and both attorneys, the seller side and buyer side attorneys. So everybody's aware an exchange is going to take place. So in this graphic here, we're the qualified intermediary down below. Your client up top is the exchanger. We're going to prepare documents before the sale closes. The number one reason why a taxpayer needs an intermediary to do the exchange, the IRS says they cannot receive the money at sale closing. So if the seller, their broker, their attorney, their financial advisor, anyone related to that seller touches the money, receives it after closing, even for a minute or overnight, there's no exchange. It's too late. So we're really adamant to say everyone needs to be on board. The attorneys understand, or the title companies, whoever's doing the closing, understands it as an exchange. They get permission from the seller to wire the proceeds to IPX, and we hold that. So the closing goes completely as normal. Real estate commissions are paid, recording fees, deed stamps, mortgage payoffs, everything goes normal in the sale, except the sale proceeds have a line item, sale proceeds to 1031 exchange. It gets wired to us. The deed goes directly from seller to buyer. We're not involved in the closing. Now we're holding the money from the sale. The clock starts in the exchange, and we'll talk about the timelines. When the client's ready to buy the new property, they send us a copy of that signed P&S agreement. We maybe pay the deposit on their behalf, or we're sending all the money to the closing. Same scenario. The purchase closing goes completely as normal. That client takes title on the deed, and we're sending in the money for them that we have. Any other money that they have to bring to closing, they send right to the settlement agent. We don't control anything but the sale proceeds. So it goes pretty smoothly. The number one thing you have to leave here with today is that the seller cannot touch the money. The exchange must be open before the sale closing date. This is really just what we've talked about already. We act as the principal, prepare documents, we hold proceeds, but the deeds in a regular forward exchange go directly from seller to buyer. So the funny thing about a qualified intermediary, or maybe not so funny, is that it's an unregulated industry. So you have, the Rhode Island, Association of Realtors. You have the National Association of Realtors. Attorneys have the Bar Association. Everybody has an industry group, and someone has holds you accountable. QIs, there's no oversight. Anyone can think this is an awesome job, decide to create an intermediary company, put out an email or post it online and say, hey, I'd love to hold your money, send it to me, and you're in. It's really pretty scary. So of course, some states have regulation, or you at least have to be registered in the state, etc. But it's really a little bit of a free-for-all. So you have to be super careful who you're referring as your intermediary. So some good questions to ask for you and your client about a QI. How long have they been in business? Are they a sole practitioner? Are they part of a larger group or a national organization? What happens if they're a sole practitioner and that person goes on vacation or goes out to lunch and gets hit by a bus? How are you going to get your money? In a larger companies, if you can't get your person, you can call someone else at the office to talk to them. How are the proceeds held? What kind of accounts are set up? Are they secure funds? Some companies will take the money and assign an account number, but behind the scenes, they're actually merging the money together and investing it to make money while it's being held in the intermediary. IPX has never done that, and we will never. We never invest money at the client's request. We open a separate escrow account for every single taxpayer separately. They complete a W-9 for us with their EIN and TIN, and that money just sits. We don't invest it. We don't allow the banks to invest it. It sits safely ready, waiting for deposit and purchase on the buy side. You always want, I'm sure you've been to some classes on the phishing and fraudsters. You may know that real estate is one of the top 3 hacked industries in the last 2 years for phishing and fraud. We see it every single week at IPX, and we're just one little company, but they are really going after everybody. They know the words, they know the process. They're in some big firms behind the scenes, CPA, law firms, title companies. They've worked their way into clients. Somehow they're sitting there, they're watching all the emails go back and forth for 2 or 3 weeks or a month. And when it seems like it's coming to closing, they insert themselves to try to get you to wire to somebody else. We have a lot of procedures in place. We move pretty fast, but the coordinators in our office are programmed to follow this step process. So we confirm from a secure location with a secure phone number. We never call somebody whose phone number is in the email to confirm wire instructions. So that should be everyone's protocol. IPX happens to have fidelity bond coverage, 30 million E&O, et cetera. Some companies have some have none. So you want to be careful who is your qualified intermediary. Basic 1031 rules. So in a 1031 exchange, I know most of you probably know this, but as I was saying in the beginning, there's so many misunderstandings about the dollar value rules that I always talk about it. In a 1031 exchange, I ask a client, what is your sale price? How much of a mortgage do you have to pay off, if any financing at all? Are you keeping all the cash? Or are you sending it all to the purchase? And we talk about it, then I email them, we talk about it again. To be 100% tax deferred, the goal is to buy new investment property of equal or greater value to their sale price. Actually, their net sale price, the gross minus closing costs. But if I'm talking to a client, I don't even say that because they think that means mortgage. So your goal is to buy equal or greater to the net sale price. 2, reinvest all of the sale proceeds through the exchange and into the purchase. Number 3, if there was any financing paid off at the sale closing, the client needs to have new financing and or new cash to match that amount on the purchase replacement side. And to be 100% deferred, they should receive no cash at closing. So equal or greater value, equal or greater debt, and roll all the cash to be 100% deferred. There's a lot of misconceptions out there. Some people think that, oh, I only have to buy something equal to my gain, or I only have to buy something with the remaining cash proceeds, even if I've paid off debt. Neither of those are correct. So here's a little chart just to kind of follow an example. So the relinquished property is the property being sold, and the replacement property is the new one to purchase. So this is easy math, round numbers, no closing costs in here, but just to follow, you're selling, the client's selling for $750. They're going to pay off a mortgage of $200,000. They'll certainly have some closing costs in the middle, but we won't worry about that for now. At the end of the day, the proceeds are going to be $550. So that's the bottom line at the sale closing. That amount gets wired to IPX for the exchange, and we're holding that in the exchange account. Then we say to the clients, okay, you have to go buy new property. The goal is to be equal or greater value than what you sold, have equal or greater debt than what you paid off, or bring in cash for the difference, and use all the sale proceeds in the purchase. So if you have equal or greater value, equal or greater debt, and you roll all the cash, it's 100% tax deferred, no taxes are due. Sometimes the clients say, well, wait a minute, I want to keep some cash at closing. Maybe they want to keep $50,000, pay off some credit cards, buy a car, whatever. They can totally do that. It's perfectly fine. But that $50,000 they keep is automatically taxable. They call it boot. So if the client keeps any cash at the sale closing, it's going to be taxable against the gain, even if they bought for greater value. Some people just want to buy with the $550 and don't want to buy anything else. They don't have the extra cash. They don't want another mortgage. So if you bought something only for this $550 and you sold for $750, you're off by $200,000 pretty much, whatever the mortgage financing paid off was. That's taxable against the gain as well. It's called mortgage boot. And people don't understand that. It's still their money. The gain is calculated on what you bought it for versus you're selling it for. It has nothing to do with whether you got a loan or not. And that's a big misunderstanding for people. I already talked about this. Any closing costs are all fine to be paid at the closing. They're considered netted out of the gross. Boot. Boot is anything that you receive that's going to be taxable. So that's the cash received if they take any money at the sale closings. It's also on the buying side, consider points or loan fees, anything associated with a lender is considered boot. So sometimes it doesn't happen too much anymore, I don't think, but sometimes on the buy side, people used to get a loan and then they would either get a second or they would get a loan for a little bit more than they needed because they were going to do some construction right away. They cannot receive cash at either closing without it being taxable. So the timelines in a 1031 exchange. You can see the little time chart down below here. Day 0 on the left is the sale closing date. That's the date that we use from the settlement statement. It starts the clock. And from there, the taxpayer, the exchanger, only has 45 calendar days to identify to us in writing on our form what property or properties they plan to purchase. They have a full 6 months to close, but they only have the first 45 days to identify what they want to buy. Identify means they have to list the exact property address, city and state. If it's land, it's book and page in a county or parcel ID, but they have to identify the exact property or properties they're purchasing in the 45-day window. If the taxpayer doesn't identify anything in 45 days, the exchange is automatically over, according to the IRS. We'll close it out on day 46, and we'll return the funds to the client, and they will pay the taxes as if they never did an exchange. If they identify property inside the 45 days, and then sometime after that, maybe day 60 or 70 or 80, that property falls through for any reason. The seller has a heart attack or dies. There's a fire on the property. You finally get all your due diligence done and see that it's terrible property. You absolutely don't want it. Any of those reasons do not matter to the IRS. If you identified property in the 45-day window and you cannot purchase that property by day 180, the IRS does not allow your client to identify other property. The exchange is going to expire at day 180, funds are going to get returned, and they're going to pay the taxes. So this timeline is actually your biggest marketing tool, because when you're talking to a prospective client that's thinking of selling, you should also try to get them to entertain thoughts of what they're going to buy as replacement property. And if you're willing to, and they're buying in your area, you could be helping them on the sales side and helping them on the purchase side at the same time, getting the 2 commissions, with the 1 client. If they're not, or say maybe someone's coming from somewhere else and they're buying in Rhode Island, then you could say, oh, when you did the exchange, what was your day 45? We need to know, because you have to identify property in that time. Some other tax issues for 1031 here, we'll just talk about it quite quickly. It's called tax straddling, and this really occurs in between 2 tax years. So for most people, they're calendar year filers, but they might be a June 30th year end, or they might have a September 30th year end. So whenever the tax year changes for for your client, the taxpayer, this is an option. So in 1031 exchange, we'll use the calendar year December, January, just as an easy example. If you sold property in the calendar year 2023, we'll talk about last year, and I sold property in 2023, but you're going through to 2024 during your exchange, you always get the full 45 and 180 days, no matter whether you're straddling 2 tax years. The catch is, or actually maybe even a bonus, like not a catch sounds negative, is that if your day 45 or your day 180 ends the next tax year and you get money back from the exchange account because it failed, or some partial failure with some of the cash back, that taxpayer can actually elect to push those capital gains taxes out to the next year. So it's really a decision for them with their accountant. It's not for us or you to make. They have to talk about it. But a lot of clients who are selling towards their tax year end use this tax straddling strategy to sell property, even though they think they may not identify or buy something else, because they're trying to push the capital gains taxes down the road a year for whatever reason as a benefit. So if somebody was selling property in July of 2023, they identified property but never closed, they'd get their money back in January of 2024, and they could bump the taxes out 1 more year, not due till 2025. So that's just a tax straddling benefit. We usually talk about it and send out emails towards the end of the year on it. But as I said, some clients have a different tax year filing. When you're identifying replacement property, 3 property rule is the most common, but there's also the 200% rule. You can identify up to 4 or more properties, but you have to list their price. And when you total those prices up, those 4 or more that you identified cannot exceed twice what you sold. So clients have to be very careful. They can't just list 5, 10, 15 properties to identify for purchase. They have to be thoughtful and direct. They have to know what they're buying. So I always encourage people to start looking for their replacement property and try to make offers on it even before the sale has closed. You can always make an offer on something and to lock it in with a signed P&S agreement ahead of your sale closing. That's perfectly fine to do. I'll just talk about this quickly. There's replacement property options out there on the security side. You may have heard of them or been to an event where they spoke about it. DST, or Delaware Statutory Trust Programs. So in this scenario here, the clients maybe are selling a property, or they want to sell a property with you and they want to list it, but they don't want to sell because they don't have anything to buy, or they're sick of managing properties and they want something hands off. Well, maybe a single net lease property or triple net lease property is a good answer for them. But also on the security side, there's programs that are similar to REITs that are out there. And in that scenario, what happens is that the sponsor company finds a property, maybe it's like a $50 million Amazon warehouse or college student housing or government building or self-storage, whatever it is, but a very large institutional scale property. And they get it approved by the Securities Commission, they get financing for it, and then they come out and market to people doing 1031 exchanges and say, hey, do you want a passive opportunity to do it, own some real estate and not have to deal with the day-to-day responsibilities? So they're similar to a REIT, but a REIT doesn't qualify, a DST does. And we can talk about it further. You can call me anytime, but I mention it because some of you may be on the security side as well. But more importantly, sometimes it's a good motivation for you to get a prospect to become a seller when you can't get them to budge otherwise because they don't know what their end game is and they don't want to pay the taxes. So this is sometimes a good option for them. So 1031 vesting rules, how you're on title. The same tax entity that sells has to be the same taxpayer entity that buys. So any entity can do an exchange, a trust, a partnership, corporation, etc. But the problem comes into play when there's different entities on one side than the other. There might be a trust, a revocable trust, or grantor trust, or nominee trust, or a single member LLC, which are pass-through entities, which means there might be a trust on title or the LLC on title, but they're really disregarded, and the underlying owner or beneficiaries or member is really reporting under their social security number or tax ID number. So we follow the underlying tax ID numbers for an exchange. The big problem that we see, as I mentioned earlier, is we see a lot of partnership and LLC issues. So as I said, any entity can do an exchange, a partnership, an LLC, trust, what have you. But a multiple member LLC is actually usually filed as a partnership. So it follows a lot of the tax partnership rules. Anyone selling an interest in their entity cannot do a 1031 exchange because it's not real property. But a lot of times we have these scenarios in place. So scenario number 1 might be the partnership owns a property and say there's 3 partners. They want to do a 1031 exchange, but one partner does not. So the partnership owns the property, it files under its EIN, so the IRS thinks the EIN is the owner, but then behind the scenes, the 3 of them get K1s. One person wants to go away, get the cash and leave. If he sells his interest in the partnership, that's not exchangeable. Maybe one choice is that they deed out from the partnership, deeds out that cash out person's interest. So now they're on title as the partnership for 2/3, tenant in common with the cash out person for 1/3. Then the 1/3 person could sell their interest, a purchase and sale agreement, 1/3 tenant in common interest to the partnership or to another person and do a 1031 exchange. Another scenario, a partner owns property and wishes to sell. All the partners want to exchange, but they want to go their separate ways. So they do not want to stay together for good or bad. And so in that case, they're supposed to stay together, right? Because that's what the IRS says for the vesting rules. But there are a few scenarios that you can look at. And one that you've probably heard of, I've even probably talked about it before if you've been in an event I've been at, is a drop and swap, where the partnership or the multiple member LLC drops down, deeds down from the entity to the individuals, tenants in common. So the deed is done. When they go to sell, they're selling as individuals for their percentage. So then the QI can set up an exchange for Joe. Dave can take the money and pay the tax. We can set up an exchange for Steve separately, and they can go their separate ways. Doing a drop and swap is not that difficult, the mechanics of it. The problem is it's not a conservative transaction because the IRS thinks if you change entities right before a sale, which a lot of people wait until the last minute, a month or two before, sometimes a week or a day before, then it's considered a flip. The clients only own the property for a day or a week or whatever, purposely, intentfully to sell to the buyer, to flip it. Even though they're the same people that used to be inside the entity, the IRS does not look at it like that. So this is something that needs to be talked about with their tax and their legal advisors, evaluate what's the best decision. Of course, doing a drop and swap should be like a year ahead. Nobody ever is that far out. So it's really a case by case for clients, but we do see this a lot where the advisors say, just go ahead, let's do it. We can prove good reason or good intent. But again, not up to us, up to the tax and legal advisors. There are other scenarios here. Oh, this just talks about the partnership form, so we won't worry about that. You don't fill those out for anyone. But there's also other scenarios here. So say you have A-B partnership and this is the only asset they own. And A wants to buy out B. So they want to go their separate ways. Well, A has another property to sell and will do a 1031 exchange and then wants to go on and buy the other 50% interest from partner B. So before I said you cannot buy a partnership interest, right? But in this particular case, under a revenue ruling back in 1999, 99-6, it says that if person A sells property and is partner in AB partnership, LLC, it can buy out B for 100%, and then it automatically converts to a single member LLC. So now A sold under its tax ID number and it's buying under its tax ID number. So again, you don't have to know everything about all these scenarios, just to keep it in the back of your head. So if someone ever is talking about this scenario, you could say, wait, I think you can do that. Let's find out. Just to put the bug in your head. Another one talks about technical terminations. I won't go too much into this, but it used to be that if partner left, the whole partnership had to terminate. And so rules went into place a few years ago, and it said as long as one partner remains in the partnership, it does not have to be terminated. They, of course, have to have two people to keep it running, but one of those only has to be the original partner. So if someone's in a partnership, they can sit, the other person wants out, they can sell and it doesn't have the termination effect. So this example, Main Street Partnership has an asset worth $100. A and B are the current partners. C wants to buy in. So C could buy 1% from B, the person who wants out. So now A owns 50, B owns 49, and C owns 1. Now there's 3 partners in there. So now what they can do is they can actually do a 1031 and do a tenant in common, switch out that partner to 49%. So when they sell, the partnership that wants to exchange has a conservative event and can continue on. Again, you don't have to know everything about it. It's a quick explanation, I know, but just to keep it in your mind for the future if need be. In the next 10 or 15 minutes we have left, I really wanted to talk about a couple of topics. One is reverse exchanges. So you've probably heard a lot about them. We've been getting more calls than ever in the last year or two about reverses. Just the way the market is running, the timing, people find something comes up that they want to purchase. They have other property they can sell, but they're not ready to sell it yet. That's probably the prime example. They weren't thinking they were going to sell. They need to wait a little bit. Someone's lease is coming up, but not quick enough, and they need to jump on this purchase. So in a reverse exchange, the taxpayer, your client, needs to close on the new replacement property before they've sold the other one, right? So a regular forward exchange, you sell first and you buy second. In a reverse, you're buying first. So since the IRS requires that it be an exchange with the intermediary involved, the taxpayer, your client, is not allowed to buy first. They cannot be on title to both what they're selling and buying at the same time. So we create a parking entity. They call it an EAT, which is a terrible acronym, but Exchange Accommodation Title Holder. So we as the intermediary create an entity, a single member LLC, and we actually physically step in and do take title on the deed to the purchase replacement property. So we create an entity. We have a company name that's the member. That's the whole point. Your client cannot be the member. They can be the manager, so they can sign everything at closing. They can lease it out, fix it up, oversee construction, whatever their plan is. They can be the manager of our LLC, just not the member. So we create a single member LLC. We step in at the closing and buy the property. So my number one question when people want to do a reverse is, how are you going to get the money to buy the new one if you haven't sold the other one yet? If they say, oh, simple, I have plenty of cash, or I have a line of credit or whatever financing, I say, okay. If they have to get financing from an institution or a hard money lender, they have to go slow. Not all lenders will allow reverse exchanges. On the commercial side, it's much more prominent. And if they do construction loans, commercial loans, portfolio loans, everything's pretty much a one-off. So they're certainly able to entertain it if they want to. Not every institution wants to. I think that if they like their clients enough and they want to keep their clients, they're willing to listen. And once the lender has a conference call with us and probably the bank counsel as well, they start to understand that it's not as terrible as it sounds for having someone else on title. We are only on temporarily 180 days, and there's a lot of things in place to protect the lender as well. So this is just kind of an example of this. Like, we create this EAT, this title holder LLC, and we take title to the purchase. We sit there on title and we hold it. When the time comes for the sale to happen, the sale closes as normal exchange. The money comes to us. We pay back the client, or we pay back the lender, or both, with whatever money we got from the sale. So they fronted the money for the replacement purchase, and then we pay them back at the end with money from the sale closing. So it's a parking transaction. IPX is buying the property for the client, and we're parking it, holding it for up to 180 days until they can get the other property sold. It's definitely more involved than a regular forward exchange, but well worth it compared to what most clients have been having to pay in capital gains tax if they can't do a regular exchange. Some of the practical considerations I already mentioned about the lender, that's probably the number one. We want to get to them as quickly as possible just to kind of feed them out. They might have to change lenders, who knows? So they really want to get engaged with that lender up front. A lot of times the front person in the institution may or may not give the right information, or may not know. It usually has to go up the chain a little bit to get approval for a reverse. They always have to have commercial carrier, the residential, even in residential properties, they have to have a commercial insurance carrier while we're on title. We need at least $1 million liability and up. Number 3 is super important. If the property is a commercial, industrial, retail, raw land, we at IPX require an environmental phase 1 to review before we'll decide to do the reverse. In a regular forward exchange, it doesn't matter to us because we're not on title. But because we're part of this parent company, Fortune 500, publicly traded, they do not like reverses. They don't want us to be on title to anything, but we do it because we're a full service. So we review title commitments from the attorney or title company that comes in, and we have to review the environmental phase 1. If we see something that draws attention, we ask for what's the next plan. We need a phase 2. What's going to be the remediation? When is it going into place? So we can get comfortable with being on title to that property. Even if it's temporary, once you're in the chain of title, you're in forever. So we want to be super careful. There'd probably be more legal fees involved, I would think, when you're doing a reverse exchange. In some states, there's double transfer tax stamps. I don't think this is an issue in Rhode Island, but we would always confirm every single time I do a reverse in Rhode Island, we double check with the legal counsel, ask the attorneys to confirm. Because what happens is when we take title, that's a closing, right? We're taking title from that seller. But at the end of the reverse, we transfer the property back to the taxpayer, the exchanger, in a deed. Do they have to pay the tax stamps all over again? I don't think so, because we're transferring for minimal or zero consideration, but we always want that confirmed. Sometimes there's a choice to be able to keep the single member LLC that we created. So we could create the LLC, do the whole reverse, and then we can actually transfer the LLC back. So the membership interest would switch from our company as the member to the taxpayer as the member, and they could keep the LLC. And actually the lenders like that choice because then their loan documents remain completely the same. The manager is still the same because it's been the taxpayer all along, and they don't have to change anything going forward. So again, a reverse exchange is a great option for 2 reasons. I'll just finish. If your client finds something to purchase and they don't have time to sell first, or maybe on purpose they're doing a reverse exchange or they were doing a forward exchange, a regular forward exchange, selling first, buying second, something happens to that sale, it slows down, and now you cannot extend the purchase. They weren't intending to do a reverse, but now automatically have to switch to that. Those are both happening often around the last year or 2. So the build to suit or improvement exchanges, just in the last couple minutes. So there are construction, improvement, build to suit. They're all the same term. For when a client is selling property, say they sell for $1 million and they're going to buy new property. Well, they're supposed to buy for $1 million, right? But what if they find this wonderful property they want, but it's only worth $800,000? They're off by $200,000 between the sale and purchase. They would have boot and taxes due, but they say, wait a minute, I'm going to use that extra money to build or make improvements or gut rehab or whatever, roofing, siding, windows, whatever it may be, utilities, whatever it is. So they're going to use that money. If they buy the property and close on the $800,000 purchase and then make the improvements, those improvements will not count in the exchange because it happened after the purchase closing. So similar to the reverse, we become a parking entity, we create an LLC, and the sale closes, the money comes to us. We use the first amount to buy the new property for $800,000. And then if we still have money in the exchange account, we're going to sit on title like an LLC. We're going to lease the property back to the client and say, go. And as quick as they can, they want to do as much improvement as they can in that 180-day window. They're going to use up any exchange funds we're holding first. And then if we've used up all the money in the exchange, they can use their cash or lender financing and keep building, keep improving until day 180. We have to be off title. So if they bought for $800,000 and they got $150,000 worth of work done in that window, When we transfer the title back to the client, it's worth $950. So now for tax reporting, they really sold for $1 million and bought for $950, not $800. So a build to suit exchange, the improvements have to be done within the exchange. We as the intermediary have to be on title. Top of the heap exchange is a reverse improvement combination, where this is usually, I see it most if there's a business. So this company has a manufacturing business. They're going to buy the building on the next town over. They have to rehab it, fix it up, and then move. So they have to buy first in reverse, improve the property, and then sell afterwards. Sometimes if they cannot get everything done in 180 days, they might do a sale leaseback on their relinquished property. So we've seen this restaurants, businesses, a lot of anyone who's auto body shops. Sometimes if they're buying first and they're going to make improvements and then move their business over there, they have to do a reverse build to suit combination. So just in a summary here, and then we'll open it up for Q&A, targeting the investor market. So obviously, you know, there's investment property owners are a lot less emotional. They're more about the profits, not paying the taxes. What can they do with their equity? So they're looking for ways to save. You'd be surprised how many very savvy investors or who have savvy advisors do not know about 1031 or do not understand it correctly. You're the first time, or sometimes you're the first ones on the scene to talk to a client about selling. So this is a great opportunity for you to mention it to them. Let them start to think about what are their options. Is it something they want to consider? And maybe it'll help your sale move along a little bit quicker because now they have their eye on the prize for a purchase somewhere else. I can help any way that you want. We can, sometimes I'll have the brokers will email me and CC their client and say, hey, Patty, I'd like you to meet John Smith. He's thinking about doing exchange. Take it away. And I can talk to them about it. You might want to schedule a conference call and we'll have a conference call all together and talk about their scenario so you can be involved, so you can be as involved or uninvolved as you want to be. I have a lot of times we have strategy sessions. People don't even know what their choices are. So that's really planning up front, even before they're thinking of selling. Of course, if somebody already has a contract under agreement and they weren't going to do an exchange, they can still do one anytime until before the sale closes. So not that I'm condoning this, but you can call me a couple days before the sale or a week before, what have you, and say, oh gosh, the client just called me. They heard about an exchange. They want to sell. Can we still do it as an exchange? And we can definitely get it set up. Reverses, not so fast. They take a couple weeks at least, but a regular forward exchange moves pretty quickly. So nobody likes to be rushed. I think there's a lot of documents involved that the client should review, a lot of things that they misunderstand that we want to clear up. But again, happy to help any way we can.
Patty, thank you very much.
Yep, thank you.
I appreciate your time. I know I don't see any questions in the chat, but I know in my 43-year career, I've done a lot of the commercial 1031s. But the people out there that might be selling for that one art, you know, that small investor, you could do the conversion to buy that retirement home. I've done that a number of times. You don't think of that aspect of it and rolling it into a 1031. So, Patty, I'm glad you brought that up as a topic there because that's gotten me a few sales in my career because that person didn't want to be a landlord anymore, but was moving to Florida or in his retirement or their retirement or the Carolinas, and they bought a rental property down there, and then they converted it to their primary residence there.
Yes.
I guess the other thing I'd like to talk about is you've probably gotten many calls on this, the misconception of a reverse 1031. Oh, I sold my property. I have the money. I don't want to pay a tax bill now, and I'll do a reverse mortgage. Maybe you can talk about that. I guess that happens quite a bit, correct?
It certainly does. Yeah, many times people call and say, I sold my property. I have the funds. okay, I'm ready to do it, or I didn't think I was gonna find something, but all of a sudden I did. Once the sale has closed and the taxpayer receives the money, it's too late to do an exchange. There's no exceptions to this. First of all, because legally, we prepare an assignment. We assign into the P&S agreement to be able to receive the proceeds on behalf of that seller. If the sale has closed, there's no more P&S. That contract is finished. The second point is the IRS says that taxpayer cannot control or receive the money. So sometimes they say, oh, it's just sitting in my bank account. I haven't spent a penny. It doesn't matter. If they've had control or their advisors have had control, it's unfortunately too late to do an exchange.
Right, thanks. I have one other question. One of the people that did this and what said, well, I'm gonna buy my daughter a house and she'll be the tenant. Let's do that. Is that okay? Well, whoever the investor is leasing to, if it's a family member, does that taint the transaction as long as it's an investment and they're paying fair market value for the rent?
So the IRS doesn't have too much in writing on this, but certainly if you're buying a property for a family member to live in, it has to be a year-round rental.
Right, same rule.
And you have to have a lease agreement in place. So it has to be arm's length, fair market value rent. I would tell people I think they should collect a security deposit. They should have them sign a lease, just like if they were a stranger that they were leasing to. Collect rents, because you want to report it on the tax return exactly as you would if it was a stranger. So
Right.
as long as it's a year-round rental, we're pretty comfortable with the fact that they can lease it to a family member. But if it's just part-time or seasonal, it really looks like a vacation or a second home, really. Even if it's not in a vacation area, like it could just be a second home downtown somewhere or in any town. We see it a lot where you might not see it as much in your side of things, but sometimes people have a condo or a house and they own, you might own it, but your elderly parents are living there. And so you're not collecting rent or reporting it because your parents are living there and you're keeping an eye on them. Well, now the parents move to assisted living and you want to sell that property and it's really a second home sale. And people are like, well, wait a minute, it's right in the middle of downtown, whatever. That's not a second home, but it is your second home that you had not reported rental on.
Right. I think people out there, practitioners, need to think a little bit out of the box because there's more than just a traditional opportunity that's looking there every day. So, give Patty a call, like she said, do a strategy session, do a conference call with their advisors, and hopefully can put a nice sale together because a lot of them, like Patty said, you're going to make a sale and you're going to make a purchase, 2 commissions, right?
Yeah.
Well, Patty, thank you for your time. I know it was very enlightening for everybody. I know I learned quite a few things. You spoke earlier that you have their certificates probably out by Friday, so they can expect those within the next few days.
Well, no, not out by Friday, out by next week.
Oh, okay, sorry. Right. We don't want to put you on the wrong date. All right, well, thank you, everyone, and I
No
hope
one
you
panic.
enjoyed it and look forward to some more of our continuing ed classes. Thank
Very
you.
good. I hope I see you all soon. Thank you.
Bye, Patty. Thanks.
Bye-bye.